Hi, everyone. Thank you for joining us today. Please use the question section on the toolbar to ask questions throughout the presentation. We will be holding and answering all questions at the end of each section. Now I'm going to turn it over to Monica.
Hi, I'm Monica Khalife from Withum Wealth Management. On behalf of the entire Withum Wealth Management team, I'd like to welcome you to the first of what we hope will be a series of webinars covering different topics of interest for clients and friends. Our focus will be to bring outside guests and experts to share their views and perspectives, not only on markets, but in other important areas of our life. We are very excited today. We have two amazing guest speakers that are going to share their views and thoughts on markets, the economy, technology, social media, and how they are all intertwined. Lisanne, Sarah, thanks for joining us today.
Thanks for having us.
So first, let's jump into the world of markets and economics. Our first guest, Lisanne Saunders, really needs no introduction. I'm sure you've seen her in a lot of media outlets. She is a Senior Vice President and Chief Investment Strategist for Charles Schwab and Company. At Charles Schwab, Lisanne has a range of investment strategy responsibilities that go from market and economic analysis to investor education, and it is all focused on the investor, on the individual investor. Lisanne, thanks for being here.
My pleasure. Thank you.
It's been quite a year. I'm sure we all know 2020 was a year that is going to go in the history books for many different reasons. Probably not the ones we wanted, and probably not the year that we expected. Can you talk to us about where we are today, where we come from, and how the path to normalization looks going forward?
Sure. So you're absolutely right, Monica, and it is the ultimate understatement to say that this has been a unique period of time. But I want to talk about some aspects that make it unique, maybe that aren't the obvious ones. Clearly, we had what started as a health crisis became an economic crisis. And in response to that, we saw something we've never seen before, which is the scale, scope, and speed that we got, not just what the Fed did on the monetary policy side, but what Congress did on the fiscal side. And of course, the Fed has maintained very easy monetary policy, and we're in the midst of negotiating the third round of fiscal relief. And combined, it caused a surge in money supply of more than 25%. We've never seen that. And that's very different than what happened during the financial crisis, because most of what was done in the to sort of combat the financial crisis was done by the Fed. This is different because much more was done on the fiscal side. And it had the effect of condensing the bear market to really only 5 weeks. It was an extraordinarily short market. And I think the combination of that stimulus, but also the speed, allowed the market to have just an extraordinary rebound. It's the strongest rebound off of a 25% decline in the stock market from an all-time high that we've ever seen in history. And I think part of the reason why we didn't see any significant denting of sort of investor psychology was bear markets tend to work their way into the psyche of investors through a combination of price and time. So big drops in the market obviously weigh on investor psyche, but when they're over an extended period of time, like the bear market from October of 07 to March of 09, that's a double weight. In this case, we're talking about less than 25 trading days. And I think it was the time factor that allowed that optimism to kick back in. And we've had several phases in the market recovery. Up until early September, it was really just concentrated leadership in the so-called Big Five, the thrivers during the pandemic. And then when we got the vaccine news, the market broadened out. I'd say looking at 2021, I think we're going to have a boom in economic growth. I'd just be mindful of not extrapolating that too far into the future, simply because the math is going to stop working. We're going to have very favorable comparisons relative to second quarter of last year. And I'd say from a market perspective, I think the success of the market has bred what has become one of the biggest risks, which is that there's a lot of speculation and a bit of complacency. So that's one of the risks, I think, that may be embedded in some of the weakness we've seen recently.
Thank you. And I think you mentioned it that now, I mean, that it's broadened out, and the recovery is also getting, picking up steam. But a lot of the things that I heard over, the past, few months is also this dichotomy between what's happening in the real economy and what was happening in the market. Is that no longer, or is there still a bit of a disconnect?
When there's lots of ways to think about the relationship between the stock market and the economy, not to suggest that the last year is anything resembling normal, but looking at the long history of full market and economic cycles, eras where you've got both a bear market and a recession, and then you come out of it. There's really very few exceptions to the market moving first. The stock market is a leading indicator. It tends to anticipate inflection points in the economy, doesn't wait for the economic data to actually turn and move back into positive territory. It's human nature for us to look at economic data and think of it strong versus weak, good versus bad, but the stock market tends to sniff out the inflection point. And if you think about inflection points, at the bottom of the V, when the economic data stops getting worse but starts getting better, in absolute terms, that's when the economic data is its weakest, but that's usually when the market starts its acceleration. So to see a market move before the turn in economic fundamentals is actually quite normal. But specific to this environment, really for much of the first 6 months of the recovery, when economic data was just horrible, again, you had such concentrated leadership. As of early September, the big 5 stocks in the S&P, so Apple, Microsoft, Amazon, Google, and Facebook, they were up 65% through early September. The entire rest of the S&P 500 was only up 3%. So if you actually look under the hood of what has been driving the market, it's a bit more connected to what was going on in the economy. A very small subset of winners for the first several quarters, and not broadening out until we actually got the light at the end of the tunnel represented by the vaccine news. So again, I think just peeling the one layer of the onion back kind of helps explain or maybe put that perceived disconnect into a more connected context.
Great, thank you. And talking about vaccines, any thoughts in terms of so far the rollout, or what could hinder this recovery? Any thoughts there?
Yeah, so for the most part, the rollout has been quite effective. I think we're going to see and already seeing some hiccups in supply because of the severe weather in large swaths of the country. So I think we're going to have a bit of a weather hiccup. But I used to live in Connecticut until last year, and my parents just had their second doses and called and said that Connecticut's about to roll out 55 and older, which is my age bracket. It hasn't yet hit in Florida, but so far so good. I think the one thing we have to be mindful of, and I touched on it in saying we have to be careful of not extrapolating the economic surge that is going to come by virtue of stimulus, but also year over year comparisons in economic data as we move toward the second quarter will be against last year's second quarter when the economy was effectively fully shut down. So you're going to see these huge percentage increases. You have to be careful about extrapolating. And then the other thing I'd say is there's this narrative building of all this pent-up demand that will be unleashed once we all get vaccinated, whatever that means percentage-wise. But the good side of the economy, that demand has been met consistently. Housing has been booming, autos have been booming, everything housing related. Services pent-up demand just means something a bit different. If you missed 6 haircuts during the pandemic, you go to get a haircut, you get a haircut. You don't get 6 haircuts. If you missed 50 restaurant reservations and restaurants open back up, you're unlikely to go out for breakfast, brunch, lunch, snack, dinner, dessert to make up for that. So I think the services pent-up demand is just a bit of a different animal. So I'm optimistic. I just think there may be a bit too much optimism and too much extrapolating of the good news that will be a little more short-term from just a percentage improvement standpoint.
Right, right, agreed. And I know this is almost like the elephant in the room, but we have a lot of stimulus, we have a lot of debt. The Fed was very easy, continues to be, accommodative. What are your thoughts on where are we going to be on inflation?
So it's certainly a big part of the conversation right now, and we're starting to see it show up in some inflation metrics. Last month's data for the producer price input, which basically measures input costs for businesses, you saw some sort of pretty epic spikes on a month-over-month and even a year-over-year basis. But history does not suggest that there is an immediate or direct connection between producer prices and other consumer-based measures of inflation. We're not seeing it yet in CPI, personal consumption expenditures, which is the Fed's preferred measure. We do think we're going to get a pop in inflation, also somewhat due to what we already talked about with regard to economic data. Inflation went down to basically zero last year during the worst part of the shutdown. So again, year-over-year comparisons are going to take some of these numbers into relatively lofty territory compared to recent trends, but they're more of the price shock variety and that basis effect, as they call it, of doing comparisons versus a year ago. I think the risk of the kind of systemic inflation that we saw in the mid 70s into the early 1980s, I think the risk of that is quite low because there is still so much slack in the labor market. And all this increase in money supply through all of this stimulus, the velocity of that money, which measures whether that money is going out into the economy and picking up velocity, that is still basically on the floor. So we have tons of inflation, by the way. It's just in asset prices. It's in the stock market. It's in housing. It's not real economy inflation. And I think the inflation we're going to get is more of a short-term kind of price shock due to supply-demand imbalances that we're still way away from having to worry about the kind of systemic inflation we think about when we go back and look at the 70s and 80s.
Good. And where do you see the rates? I mean, the rates over the past, I don't know, maybe week or a couple of weeks have moved significantly. And I don't know where we are now, but maybe 1.3. I mean, up until what point do you see rates becoming more of a problem for equities, or what do you see on the moving rates that we've had?
It's a great question. It's certainly one of the questions I'm being asked more frequently these days. It's not as simple as just saying, we think X threshold on the 10-year yield becomes the point at which it starts to hurt equities. You could argue that one of the contributing factors to what has been a weaker market over the last week or so, the rotation away from some of the big cap leadership names, is partly a function of rising rates. But ultimately, what matters more than just the level or the movement in longer term interest rates is the why behind it. If you have rates moving up because growth expectations are moving up, and particularly if growth expectations are moving up more than inflation expectations or actual inflation, that's actually a positive backdrop for the stock market. The opposite situation, if rates are moving up more because of the inflation side and less because of the growth side, that tends to be a more negative environment for equities. So again, I think it's been a contributing factor to recent weakness, but I think, looking ahead, the why is going to matter. That relationship between growth and inflation in terms of nominal and real yields, that matters more to equities than just some simple numerical threshold on yields.
Thank you, Lisanne. And you mentioned it right now, so I think this is a good segue into another topic that we'd like to discuss. This rotation that and maybe since September or earlier this year, we started to see. I mean, what are your thoughts on the staying of that rotation, and where do you see the funds switching from and into?
I think at the sector level, and even to some degree at what I call the factor level, the types of factors that move in and out of favor, I think sort of extreme movement and changes in leadership, I think is going to continue. That ostensibly suggests a tougher market environment for investors to navigate, but not if you take the right approach. I think a lot of investors think the key to success is anticipating in advance, okay, what over the next month or 2 months or 3 months is going to be the leadership sector, and then moving money in there. But when you have these rapid movements, the best solution actually to that is to react to that. And I don't mean chase performance. That's one of the perils investors always sort of face when trying to do this, but react by maybe rebalancing a bit more frequently and take advantage of some of these swings and trim where strength has been dominant recently and add to maybe where there's been weakness and stay in gear that way. You mentioned the September time period. That was a really crucial, I think, turning point for the market. Year to date through September 2nd. Now, September 2nd is a key date for a couple of reasons. It was the initial date that both the S&P 500 and the NASDAQ went to new all-time highs. But the leadership was so concentrated at that time that the big five names, those five largest names in the S&P, which I already mentioned, at that time they represented 25% of the S&P 500 because it's a capitalization weighted index. They're only 1% on an equal weighted basis, 5 stocks out of 500, but 25% of the index. On that date, year to date through September 2nd, the big five were up 65% on average. The entire rest of the S&P 500, the other 495 stocks, were up only 3%. Then we started to see a rotation. You saw a corrective phase in those stocks. You saw throughout September and October kind of rotation back and forth between, at times you could define it as growth to value, at times from large to small, from defensive to cyclical. It was sort of in fits and starts. Then early November came, you got the initial vaccine positive news out of Pfizer, followed by Moderna, et cetera. And that really broadened out even more to areas that had just not participated, energy and financials. But even since then, we've seen these jumps in leadership. In fact, technology sector has been the best performing sector for only 3 months out of the last year, but it's the best performing sector over the course of the last year. The energy sector has been the worst performing sector out of the last year, but it also has had 3 months where it's the best performing sector. There's so many ways to slice and dice this, and to try to anticipate what the next move is going to be. We're still going to be at the mercy of the virus. Even though we've got the light at the end of the tunnel associated with the vaccine, we're still at the mercy of the virus and the hits to the economy and the labor market. And I think that'll keep kind of sector rotation in a choppy fashion. It's not what we know that makes us successful as investors, because we don't know what's going to happen. It's actually what we do. It's our behavior. And I think maybe more frequent rebalancing and staying in gear by adding low, trimming high is probably the best approach for investors to take.
Yeah, that's great advice, Lisanne. Thank you. And what about the countries or foreign stocks and foreign emerging markets, and how's that relationship with the dollar going to continue over the next, year or so?
With regard to the dollar, we think the path of least resistance is still for the most part down on the dollar, but I think it will be subject to some counter trend moves higher we've seen recently, some either driven by interest rate differentials, but also sometimes just sentiment driven, because currencies have become a vehicle that can be more actively traded even by retail investors. You tend to sometimes be at the mercy of kind of one-sided trades in a sentiment environment that in and of itself can just mean you get counter trend moves even without a change in fundamentals. So we need to be mindful of that. But broadly, we think when you exit one kind of full cycle, meaning a market cycle in conjunction with an economic cycle, and go into a next long cycle, you tend to see those usher in leadership shifts. And we think we are in an environment where global diversification is going to pay dividends, which has not been the case for certainly the last cycle, where US large cap was sort of the only game in town. And so we now actually have an overweight from a tactical perspective on international stocks with an offsetting underweight to US large caps. That's just kind of a relative. We just think that, again, outside US is probably going to be an effective diversifier. We've also last year moved to an overweight to emerging market debt for investors that sort of want to pick up some yield. So we think that there are opportunities both on the fixed income side and on the equity side outside of the US, somewhat driven by currencies, but also very much driven by valuation differentials, which given extremely high valuations in the US, much less so outside of the US. And also we think correlations and will be coming down, divergences moving up, which just makes the opportunity for diversification to work in your favor greater than it's been in some time.
Great. And let me just bring in some questions about the new administration. I mean, do you see any changes or any thoughts on the new administration and as to how they impact markets or relate to different sectors of the economy?
Yeah, so I think one of the interesting things that I think got lost in the extreme focus on the Georgia runoff elections in early January, because of course that's what ultimately decided the makeup of the Senate, was the fact that along with the presidential election were a lot of House elections that actually significantly narrowed the leadership bias by Democrats within the House. So this notion that once the Georgia runoff elections went to Democrats and basically all three branches were in Democrat control, the House, the Senate, and the White House, that this was some massive blue wave. It was really, I think, more of a blue ripple. And if anything, we're seeing the kind of rising power of those on the more moderate end of the spectrum. I've seen political pundits actually say that, Joe Manchin, a fairly moderate and conservative Democrat, is sort of, has a lot of power right now. And so this notion that, okay, Democrats now control all three, that's going to unleash massive progressive policy. We're actually witnessing how the sausage gets made in Washington. We're seeing it with what's being negotiated right now, fiscal stimulus. The next up will probably be infrastructure, and there's a lot more chatter about less of a focus on tax increases. Even if it gets put into the infrastructure bill, our kind of man in Washington, my colleague Mike Townsend, points out that tax increases don't tend to be retroactive. So the tax story, if there is one, is probably more of a 2022 story. Now, that may not sit well with people who never want taxes going up, but from a planning perspective, I think that that's important. So I think that we're seeing a bit more kind of moderation versus a giant pendulum swing to extreme progressive policies. Just the makeup of Washington with a single-digit majority that the Democrats have in the House and 50-50 in the Senate means that there's going to have to be a lot more negotiation through the process of getting bills passed. And again, we're sort of seeing how the sausage is made in Washington with this relief package that's currently being negotiated.
Yeah, and they probably, I'm not sure what has a higher likelihood of passing and what doesn't. So I'm sure we'll be learning more about that. Also related to the new administration, I know some certain areas of the market started to price in or started to be a little more excited about change in certain policies, such as like green stocks or kind of clean energy. Up until what point do you think that is, all priced in already, or what's the outlook for those areas of the market?
I think it's a bit perilous to look at sometimes short-term moves in certain sectors or industries within sectors driven by elections and a shift in leadership and extrapolating them out too far into the future. Now, in the case of a lot of those sort of green energy areas. I think we have a problem that's been building in the market of not one big epic bubble a la circa 2000, but some micro bubbles in certain subsets of the market. We certainly saw it in heavily shorted stocks with GameStop as sort of the poster child a few weeks ago, and you could argue, we're seeing it to some degree in Bitcoin. And I know I'm going to hear it. I'm not suggesting that it's going by the wayside. And we had a massive internet bubble in 2000 that burst in spectacular fashion. That didn't mean the internet went away. It's still been a massive force in our economy, but things get stretched and you go into these speculative booms. And I think we may be seeing that in certain pockets of the market, like green energy and tech, that might be tied to the turnover in the administration. But just be careful about having these narratives think that they're going to last. I looked back to refresh my memory of when Trump won in 2016 and what the sector-based narratives were. What are going to be the big winners? And probably the two most dominant sectors that were mentioned as big winners under a Trump administration were energy and financials, because mostly sort of the deregulation component of it and likely persistence in easy monetary policy. Well, for reasons that had nothing to do with the administration, they didn't change their priorities, but energy and financials were the two worst performing sectors over the 4 years. The point is just that there are so many other forces that impact what the market is doing broadly, what sectors are doing, that it's not as simple as kind of putting on paper, okay, this administration is more favorable toward, X, Y, and Z sectors and less, and then extrapolating that over the 4-year cycle, a presidential cycle. It just doesn't work that way. In fact, you would think energy and financials under a Biden administration with more regulations and kind of anti-fossil fuels, yet since the election, those have been the two best performing sectors. So just, invest based on underlying fundamentals. Don't extrapolate things like a change in the, whether the White House, the Oval Office is painted blue or red. Don't use that as a basis for making, multi-year decisions around things like sectors.
Agreed. And we tell that to our clients all the time. You mention it, and I know it's a topic of interest that's been front and center over the past few months, and we'd like to hear your thoughts on that. But this whole Robinhood Reddit saga and the growth in the retail trading, how do you think that changes us and changes the industry going forward?
I think it's an extraordinary force to be reckoned with, but not as brand new as many might believe, given the heightened attention just in the last month because of the attention on GameStop and Reddit Wall Street Bets and the Robinhood kind of phenomenon. Really, kind of the rise of what I've been calling the newly minted day traders dates back to last summer, and there were lots of contributing factors to it. One, the success of the market off the lows, the fact that with all of this fiscal stimulus, that a lot of the money was then put into the market, the ease with which trading could be done on these types of apps and even on traditional platforms like Schwab. I don't know, at Schwab, we may have had something to do with commissions going to zero, just speculating we might have been a part of that. But and then people being home and being more comfortable with digital platforms and our devices, and the lack of sports and sports betting for a while. It was just a whole confluence of things. But what happened when you first started to see that huge surge in their weight in the market, as far back as last August, you had firms like Citadel calculating that retail traders were now 20 to 25% of daily trading volume, well above what we had seen in any kind of recent cycles. You really have to go back to whatever the comparable measures were back in the late 90s to point to something similar. But a lot of that sort of speculative fervor at that time, last summer into early fall, was concentrated in parts of the market that were leading anyway, those big five, the FANG type stocks. So it wasn't such a noticeable force until in January, it went into more arcane segments of the market, heavily shorted stocks, penny stocks, the lowest price stocks, bankruptcy stocks, weak balance sheet stocks. There's an overarching theme of kind of low quality here. I think the GameStop as a poster child for some of that speculative fervor, I hope is a valuable lesson about speculating in areas of the market in stocks that really don't have that fundamental support. The longer term hope is that through continued democratization of investing, we basically help turn these newly minted, more speculation oriented traders into more educated long-term investors. That might be a bumpy path along the way, but that's certainly, Schwab's mission for almost 50 years is around financial literacy. So I think that this is great to see. We just hope that they're not with overt regulation, but maybe a greater focus on education around the difference between sort of get rich quick speculative schemes in the market and long-term successful investing.
Yeah, absolutely. I certainly feel for the people that bought GameStop at over 400 or 480. So any positives that will come out of that in terms of, what the SEC learned about what Robinhood had to do, or anything that it's a good lesson going forward?
Yeah, I mean, it's. I'm not going to attempt to jump into the shoes of Gensler or other regulators to gauge what they're ultimately going to do. I'll state what has been stated by many and is somewhat obvious. They're in a little bit of a tricky situation because what they don't want to do is slap these onerous regulations on the so-called little guy and then leave sort of the hedge fund community to still do what are, many times are perceived as maybe not nefarious practices, but kind of get away with there's nothing illegal about the GameStop situation where Melvin Capital, where the short position was greater than the entire float. That can happen because when you short a stock, you're borrowing the stock, and the lender can lend out stock multiple times, so that can happen. So it is going to be tricky, but I think more education is needed about the why behind why Robinhood had to stop trading. It wasn't some underhanded deal with the payment for order flow folks. It was they were facing capital restraints because of how much trading was being done on margin, and they had to make sure that they had corporate protections in place. So I think this whole thing should be more about education, and I hope that if there are formal kind of regulations or parameters, it's more on the requirement for education than it is on sort of restricting trading for types of trading for certain segments. I'd like to see it more around education that again will help kind of bridge that gap between speculative get rich quick kind of gambling approach to investing and true long-term investing. So that's certainly what we would like to see.
Great. And let's just a quick, we're running out of time, but one quick question on continuing on the speculation, these SPACs. I mean, every day I seem to read 5 or 10 new deals. Any ideas, any thoughts there?
I mean, I'm not the type to throw the word bubble around willy-nilly, but when I think of, as I mentioned before, the possibility of where these micro bubbles are and where we're seeing speculative excess, you have to put SPACs kind of on that list. The problem with any period of speculation, whether it's the late 90s and traditional IPOs then versus the kind of SPAC vehicle today, trying to sort of time when that speculative fervor ultimately gets to an inflection point, hits some level of excess, and then you see the rolling over, the pricking of either a major bubble or a micro bubble. that is a really difficult thing to do. So I can easily say that I think we're seeing excess in SPACs, we're seeing excess in sort of that low quality trade that we already talked about with the heavily shorted stocks and penny stocks. I can say I think we're seeing bubble-like conditions in cryptocurrencies and maybe, but they can last for an extended period of time. I don't know if there's some particular data point with regard to SPACs that is going to be that bell ringing aha moment. But when I look at sort of the grouping of risks that exist out there, and what I mentioned before, the success of the market breeding its greatest risk, which is maybe too much speculation. Again, I don't know that there's going to be some bell ringing, but we're certainly keeping an eye on whether we start to get signs in the SPAC world that it's maybe moving well down the quality spectrum, and some of these acquisitions by the SPACs start to go into much more questionable companies and areas of the market. I'm not suggesting that we're there yet, but it's on the list of things I'm focusing on.
Thanks, Lisanne. And then just one quick question before we jump into a Q&A session. And I think this will help connect our next guest speaker, Sarah. What role do you think big tech and social media has really played in our economy and society and markets?
Well, it's certainly in January, looking at the GameStop saga. I mean, that really was what is probably best described as a social media fueled flash mob of investors. And there was a lot of kind of quick rotation in and out of some of these stocks. Again, maybe the good news, notwithstanding the pain for traders that got in near the top and have suffered the consequences. But we're seeing the force of social media in so many aspects of our lives. We're seeing it in sort of the movement of social forces, of political forces, more recently in the world of investing. And boy, that's not a genie that's going back in the bottle anytime soon. So I think there's a lot of wonderful things about social media, about Twitter. I'm on Twitter all day. I think there's negative aspects of it too, not least being the kind of anonymity at times that allows for a bit of a bullying status at sometimes on a platform like that. But for the most part, it is furthered the process of democratizing information and democratizing investing, and I think is a force that we now realize we have to consider, and its implications on the investing community broadly, but certainly individual investors, and frankly, younger individual investors that have kind of grown up living in the world of social media. It's more of an adjustment for a 56-year-old that has to think about the differences between investing now in 2021 versus in the mid 80s when I started in the business. But it's an extraordinary force, mostly for good, but not always.
Thank you, Lisanne. This has been fantastic. Thank you very much. We have a few questions from the audience. Let me start here. Okay. Looking beyond 2021, where do you see the economic cycle playing out into 2022 and 2023 in terms of rate hikes, tighter financial conditions, and eventually a slowing growth to end this bull market?
So that's the $60,000 question, and we know that most cycles end with a bit of overheating, higher inflation, and the Fed needing to tighten policy, either directly or policy tightens because financial conditions tighten. We know as recently as today that the Fed and Jerome Powell, the chair in particular, continues to say we're not even thinking about raising short-term interest rates. I think that maybe the bigger question near term is, will the Fed sort of be forced by the market or inflation or overheating growth to have to start to kind of taper policy, which would more likely be done on the balance sheet side versus the interest rate side. And that it probably is going to represent sort of the next inflection point in the cycle. The how soon it occurs, I think, is tricky. I already mentioned, I think we're going to get a surge in growth due to the base effect of year-over-year comparisons, this massive amount of fiscal relief, another round of which is coming fairly soon. But then I think we end up kind of leveling out. And it's going to take a while to heal what are the COVID-related scars on this economy. Things like long-term unemployment, permanent job losses. And that's what I would focus on looking ahead. The good news is I think the shift that has been accelerated out from this pandemic, I think, toward more of an investment-driven economy than a short-term discretionary consumption-driven economy is a positive in the sense that I think a lot of the industries and sectors that will be more in the catbird seat than just, leisure hospitality services, which was a big driver in the last cycle, are ultimately bigger employers. They're a more important part of the economy from a labor market perspective, but there's also needs to be a lot of education and skills retraining. This is not a speedboat turn. This is an ocean liner turn, but I'm optimistic longer term that increasing drivers of our economy are going to be more on the investment side of the economy, where our creativity and our entrepreneurship, I think, is going to pay a lot of rewards. But again, it could be a choppy path to get there.
Great, thank you. And here's another question, and you touched on this just now in what you've answered with this question, but it's saying, given what sounds like a return to normal, given the vaccine rollout, what are your thoughts on the necessity of the current stimulus plans being debated in Congress for continued economic growth?
So I think there still is need for fiscal relief. Now, what's happening in terms of the negotiations, and certainly a lot of the quibbling, the controversy, the debate is around the component parts of it. Should it be done more on unemployment insurance so that the help is targeted to people who are still out of work as opposed to just broad stimulus checks? I understand all of those debates. I'm not literally or figuratively in the room in Washington. But I think that given that we are still almost 10 million payroll jobs shy of pre-pandemic levels, still a 6.7% unemployment rate, and about 40% of those unemployed have been unemployed for more than 27 weeks. So a significant percentage of long-term unemployed, and that income replacement for those folks, I think, is still absolutely necessary. And I agree that where aid is still needed for individuals, for small businesses, can be better conducted, if you want to use that word, on the fiscal side versus the monetary side. I think Powell's been right in not saying the Fed's out of ammunition, there's nothing more the Fed can do. They can maintain easy monetary policy, which they have, but where the dislocations remain in the economy are better tackled on the fiscal side than on the monetary side. That doesn't mean we're not going to have to pay for this. The cost of servicing this surge in debt that we're seeing, I think, is a wet blanket on growth longer term, much as it has been for the past 30 years. So we're not going to be able to get away with all this spending without some future consequences. Maybe not runaway inflation, which I don't think is a big risk, or runaway interest rates. But that high and rising burden of debt, again, tends to be a wet blanket on economic growth. Another reason why you maybe want to curb your enthusiasm for the kind of surge we're going to see this year persisting for years to come.
Yeah, absolutely. We'll see that bill later on. Lisanne, we are out of time, but I would like to thank you so much for your time and for your insights. And this has been great. And I also want to thank the rest of our friends at Schwab for making this happen. I'd love to keep talking to you, but we do have another guest. So I really appreciate
My pleasure.
everything in your time. Thank you, Lisanne. Have a wonderful day and
Thanks,
enjoy Florida.
Monica. Enjoy the rest of the event.
Thank you, Lisanne.
Thank you.
Thank you.
Bye-bye.
Bye.
And thank you, Monica. And we are excited to now kind of switch gears a little bit and talk more about some social media technology aspects of the world. And Sarah Personette is here with us from Twitter. Sarah, thank you for joining us.
Thank you for having me, Elena.
Yeah, and before we kind of jump into some of the questions and themes that we have here, just to give you a little bit of a background, Sarah is the Vice President of Twitter Global Client Solutions, where she leads Twitter's partnerships with top marketers and agencies worldwide. She also oversees a team of regional business leaders, as well as Twitter's global teams focused on client partnerships, agencies, brand strategy, and creative solutions. And certainly Sarah comes with a lot of kind of background in social media. Before Twitter, she was also the Chief Operating Officer of Refinery 29. And then before that, she served as the Vice President of Facebook's Global Business Marketing Team, where she built and led Facebook Global Agency Team. So we are so excited to have you here and all the wonderful input that I know you'll share with us. So just to kind of jump right into it, I'm going to go back to the question that Monica asked Lisanne, and really thinking about kind of social media and how it affects our lives. I mean, if we think about it, we didn't have social media for thousands of years, and now you can't step one, in either direction without being affected of it. And we certainly have seen what effect it had on politics throughout during this election cycle, and also, as Lisanne talked about, the effect it had as far as the trading. So what role do you think technology and social media, plays in our lives as far as the economy, society, politics, and maybe even a bigger question is, should it play a role, and what role should that be?
It's a great question. It's a big question as well. So I want to zoom out and probably provide some trends that have been happening over the course of the last 20 to 30 years that might actually help to dimensionalize a little bit more about what Lisanne was sharing, and then also answer the question of the role that social media plays in the economy and society and politics. And the three trends I think are helpful to look at is the rise of digitization via technology, the mobile revolution, and the power of the interest graph. All three of these trends have an impact in some way, shape, or form on the economy, on society, on politics, the elections, all sort of varying component parts. So first, when we look at the rise of digitization via technology, and let's say more specifically the internet, have and will continue to promote significant shifts across all sectors of our global economy. If you look at this, and this COVID really sped up this process in many ways across multiple categories. But there is no category, there's no business, and there's no service that has not been untouched by some form of digitization, which is fueled by these component parts of technology or big tech. Internet plus mobile plus social plus the power of the data economy, and then layer on top of that machine learning. So if you look at healthcare, if you look at governments, retail, education, travel, finance, I mean, every single sector has and will continue to be reimagined. And one of the most interesting trends I think associated this is the continued rise of the Internet of Things, which is basically bringing this convergence of digital into offline industries. So we actually saw over the course of the last year, manufacturing and supply chain being completely disrupted as a result of the broader pandemic. Now we're seeing digitization really take shape and being able to close some of those gaps. Education is another great example. Education used to be almost solely in person, and now we're seeing e-learning and virtual education, which had been around before, but really take root in terms of a scaled, broad-based solution for many. Telehealth is another example where medicine and health solutions in small areas around the world had started to transform, but had not transformed to the place of scale that ultimately the pandemic wound up driving. So the internet will evolve from really being this sort of web and mobile application-based system to something that permeates all aspects of the physical world. And this pace of change via digitization will only continue to accelerate. And the businesses and the people that adapt quickly will really sort of rise in terms of success. But that's coupled with this other piece that has been a really interesting trend, which is the mobile revolution. And this one actually is like very seemingly obvious or deceptively simple. The world has gone mobile. It has been mobile for many years. And to put some numbers behind it, this is actually the fastest technological shift that we have ever seen in history. So if you looked at radio, TV, the internet, and then mobile adoption, it took 38 years for radio to hit 50 million listeners. It took TV 14 years to hit 50 million households, the internet 4 years, and it took mobile 2 years. Now, the reason why this technological shift is so important is because this is the way that most people around the world who are coming online, and remember, just a couple of years ago, 2/3 of the world's population didn't have access to the internet. Now they are accessing the internet first and foremost through a mobile phone. And this creates a series of incredible opportunities and also challenges. So on the opportunity side, and this is a stat from the UN, for every 10 people that are connected to the internet, one person is actually lifted out of poverty. The internet has created 2.6 jobs for every one job lost. Small and medium-sized businesses, which are some of the biggest supporters in terms of our platform and how we look to help grow business and grow economy, have experienced 10% increases in productivity as a result of being more mobilely oriented. And this also allows for things like upskilling of work. It allows for the better spread of information, healthcare, education, entertainment, all become accessible. But at the same time, these trends, especially around automation and the connection to mobile, are creating, plus the recession, this almost like double disruption scenario for businesses and for our workforce. And for anyone who manages large teams out there and or manages a company, I'm sure you are probably experiencing this. Because in addition to the current disruption from the pandemic-induced lockdowns and this economic contraction, which Lizanne was talking about earlier, this technological adoption by companies is essentially transforming these tasks, these jobs, and these skills. And it's essentially either reducing their workforce dependencies as a result of technological integrations, or it's actually speeding up and expanding their workforce, but they're requiring new skills. So both of these trends are foundational to answering the question of why does technology, and I'll get into it in a second around social media, but why are these platforms and these capabilities so very clearly connected and woven through the fabric of our economy, of societal change, and ultimately of the broader political environment? And I think that's where these particular trends and the pace and rate of innovation at scale is going to continue. But it also means that the leadership and the ethics required around decisioning and policymaking and management overall for my company and for many other companies is so significant. And it's actually why at Twitter, to get to the social media impact of this, we have an incredibly deep commitment to leadership and ethics. If you've ever heard Jack speak, if you've ever heard our general counsel Vijay speak, and the whole of our management team, I think we try to be very principally based in how we're thinking about the decisions and the policies that we put forth, and then also the global impact that they might have on the world. And with that, I think it's important to note just the differentiator between all of the different social media platforms today. Elena, as you mentioned, I used to work at Facebook. I think what's different about Twitter in particular is that our mission is to serve the public conversation. So we are a real-time, globally distributed public platform, which means that there's no private groups where conversation is nested and can't be seen. But we are here to really connect you to the interests or the topics that you care about. So I think about Twitter as more being an interest graph versus and connecting you to the topics that you care about versus a friend graph and connecting you to the people that you know. And so this has been really interesting over probably the course of the last 2 years as we've become really clear on making sure it's easier and faster for you to find those topics that you care about, find those interests that you care about. Could be politics, could be a TV show, could be books or authors, climate change, your favorite NFL show, K-pop for any Korean pop music fans out there. Like, these are all the examples of interests that you can now more fluidly find and converse with others that you might not know, but are experts in that topic. And all of those things collectively together, I think, require us to take note in terms of how, so on the economic side, we talked a little bit about Robinhood and the rise there. A lot of that conversation happened on social media. In society, we have, I think, been very much at the center of a lot of the social unrest that has happened in our country and around the world as people come together to talk about those issues. And with that, we always want to make sure it's a safe environment and that it's a trusted environment and one that protects your data in order for you to feel like you can come there and converse around those topics in order to feel like you can move forward in the world.
Yeah, no, and it's you bring up so many interesting points, and probably a lot of the things that everybody is thinking about. And I think the first thing that kind of jumps out at me, when you really truly understand the reach of technology, social media, and the combination of the two, the first thing that comes to mind is, as my parents would say when I was little, with greater, you have more responsibilities, the more kind of the greater things you have. So that would be my kind of question. Do you, I guess, what are your thoughts, with all that sort of impact that technology and social media can have in so many different areas of our life? What is our social responsibility as citizens? What is the social responsibility of the big tech and the social media companies? Like, how do we think through that?
For us at Twitter, if people on our platform don't feel safe, then we are not doing our jobs. And that is literally the number one priority for the last probably 4 years has been preserving and protecting the health of the conversation. We've introduced a series of in-product solutions such as conversation controls or author-moderated replies. These are, if you're not familiar on the platform, sometimes someone can respond with an unwanted reply that you just didn't want to see in your timeline. Author-moderated replies allows you to actually hide that response and move it to the bottom of your conversational thread. Or conversation controls allow you to choose who you want to respond to your tweet or piece of content that you are posting. It could be a public post where anyone can respond. It could be only people who follow you, or the third option is that it's just people that you @mention. The reason why I share this, though, is I think we as a company take that responsibility around policies, and we can get into, for example, fighting misinformation or disinformation. When COVID first hit, our number one responsibility during that time was making sure that every person who was on our platform, and our usage skyrocketed, that every person who searched for COVID was being directly matched with a credible source, the CDC, the World Health Organization, or a local organization, a local governmental body within a specific market that had the latest information. That's the beauty of our technology, being able to close that gap so that you find accurate information. Now, we just went through an election, and there has been a lot of questions around, the spread of misinformation and disinformation historically. So we've introduced policies leading up to that election, but this has global reach because there's an election that happens almost every single month somewhere in the world, and Twitter is ultimately a part of that as it connects people to converse about those elections. So we introduced our synthetic media policy last February. We also made sure that we introduced prompts that basically, if you're about to retweet an article that you have not read, that it asks you if you really want to retweet that since you haven't read the content. And just that sheer simple product ask massively dropped the spread of information that potentially wasn't truthful. We're also experimenting right now with something called Birdwatch, where we're leveraging the community to actually do more context and fact checking. So as new problems arise in society, we take the responsibility very seriously to uncover what are the right product solutions to make sure that we're mitigating those risks, and what are the right policies to ensure that that we are managing the safety and security of all of the people on the platform. And to go back to your just question on what role do we play, I think it's changed a lot, and I think the expectations have changed. When I first got into social media, it was 2009, and there was a very clear stance that social media in particular, but all of the technology companies that have been talked about today are technology companies, that they are platforms, and that they do not moderate or manage what happens on the platform. And that was a really specific stance that most technology companies took. Over the course of the last decade, I think that has dramatically changed as people actually demand that social media companies and broader technology companies do take ownership of what's happening on their platforms, and hence the reason why we are so on top of and front-footed in leading the industry on a lot of these policies related to health and security and privacy, so that the real benefits of social media, like I talked about before, that opportunity to converse around topics you care about, the opportunity to be quickly connected to information that matters to you, just the pure, we saw this in COVID, the pure ability to just have a positive interaction with someone when you felt isolation. This is an incredible aspect of this technology, but with that, we have to take the decisions that we make really seriously. And I think the most recent example of that certainly is pulling Trump off of the platform. And prior to that, we had banned political advertising because we felt that the coupling of the precision of digital advertising and the ability to target was not something we wanted to profit around. But we still allowed public officials, public leaders, to absolutely have a organic voice on the platform. And that most recent decision, though, was not one that we feel pride around. While there are people on one side who, celebrate it and others who, who are not in support of it. The reason why we don't celebrate it is that after very clear warning, we took action and made that decision based on the best information we had, which was based on threats to physical security, both on and off platform. And in any type of extraordinary or untenable circumstance, we're always going to look at public safety. We're always going to look at in addition to how we make sure freedom of speech is able to, win out as well. And coupling those two things collectively together, it goes back to the initial point of the ethics of decisioning and the management team so matters. And that's why it's a particular privilege to be a part of this management team, because their ethics-based decisioning is exceptional.
That's that's really great to hear. A lot of the kind of the background that probably myself or maybe a lot of others that are listening might not kind of, have the insight into it. It's very, very interesting. I'm going to shift gears just a little bit and kind of go back to what Monica and Lizanne talked about, and kind of the effects of social media on, on kind of this Robinhood investing, and given the rise of what happened with the GameStop stock, do you think, from kind of just again where you said, do you see that we're going to see more of those kind of coordinated, crowdsourced investment ideas that are going to come to fruition, and it's really coming from less investment focused places, and what implications that might have, again, just looking at from your perspective?
Yeah, it's a great question. I am not an investment leader in any way, shape, or form, so I will refrain from speculating on the future state of investments. But what I will say is that, and this is the reason why landing that this trend of digitization is a force that is pushing every person forward, every category forward. I think this was an example of just the start of the evolution of this trend around trading. And you're seeing everyone have access to these services very quickly and on their mobile phone or on their desktop. And you're also seeing that as millennials certainly have come of age, but as Gen Z starts to come of age as well, they were brought up in a world where everything was at their fingertips through the internet, through digital technology, through mobile phones. And so I do think, if you just looked at the consumer behaviors and the technological trends associated with it, it would be, it's safe to assume or conclude that this phenomenon essentially will play forward. Now, as it relates to Twitter, I think the thing that's fascinating for us is we have, different communities of interest that pop up. So another area that wouldn't be surprising to you or all of your clients is this really quick increase in the discussions around crypto, and our crypto Twitter community. The conversational volume has dramatically increased over the last few months. And so I think that's where we see topics or areas of interest in markets sort of ebbing and flowing that reflect what's happening in society, because we often say that what's happening in the world is happening on Twitter, and Twitter is what's happening. And that's sort of where I think, you can start to see those connection points.
Yeah, no, that makes a lot of sense, and I appreciate that. So the other thing that I feel like is at the top of a lot of people's minds is kind of this psychological effects, right? Of not just Twitter, but just social media, maybe to some extent, some might say even an addictive nature of social media, and especially as it relates to probably, teens communicating positively, hopefully, but also there could be some of that negative aspects. I mean, do you have any kind of thoughts on the kind of the psychology of that, and how we can be, again, thinking about it, or should we be kind of making changes in the way we behave, our children behave?
Yeah, it's a great question. As Elena knows, I have 2 little kids, and think about this often. So I'll answer it first as a parent, and then sort of as a representative of the broader technology community. And I'll share a story. I was in Turkey a few years ago, and I was speaking to a CEO forum, and one of the CEOs raised his hand and he said, I have a 6-month-old and an 18-month-old, and they are addicted to my phone. What are you going to do about it? And I paused and I said, first, I will share with you, I think, what the responsibility is of any technology company. But as a parent, I think that all of us need to take the phone away from a 6-month-old or an 18-month-old. That is, you don't need to give that device to, especially that young, a child. But moving forward, especially with the pandemic, I think screens are an even more incorporated part of our children's lives today. They're on it for 6+ hours for school, and then if they're still in some state of lockdown and can't interact with others, then that's a way of socializing. So making sure that we as parents are talking about and setting time limits is certainly really important for younger folks. We do this right now with my 8-year-old, also talking about the permanency of the camera on your phone, the permanency of social media, even if it's an ephemeral platform like a Snapchat, that all of that can live on. And teaching values around who you are and how you want to be seen, and really the permanency of these things, I think, matters. As an employer, it is very easy to look up how potential folks that are interviewing for the company are acting in the world, and that's something as well that is you're coaching your children to interview, make sure that what their public presence is something that's reflective of the person that they want to be. And I think that having those conversations and being really open to that is super important. It might be uncomfortable. They might certainly not want to have those conversations, but I think it shows that you care, and some of that is getting through. Now, on the responsibility of any type of company, whether that's a phone manufacturer through to gaming companies to social media companies, we do take that responsibility really seriously. We invest heavily in a lot of education programs through NGOs that work with various schools. At my past employer, they have actually worked through in the way that your feed sort of renders that once you've been on for a certain amount of time, it actually will pop up a notification that says, you've been on for this amount of hours. I think it might be time for you to be able to, or that it might be time to log off of the platform. So I think we're all experimenting with ways to both educate, but then also in real time signal that it might be important to get outside and do something else. And I think also a lot of the streaming services where it's easy to sit and binge watch as well. These are the challenges and the beauty associated with the rise of digitization. You have access to more content than ever before, but that might mean that you just then sit for a very long period of time. And so an active lifestyle, and one that is, connected to, I think, the value system of your family is super important, in addition to the work that we do around education and training of teachers and school systems.
Yeah, no, that's great to hear, and I think we kind of sometimes all in this together, right? We have to
Yep.
Both sides have to play their part. And actually, you just said something that leads me to kind of the next thought is around this. How should I say it? Kind of the data living on for forever and ever and ever, right? And there's a Netflix documentary that you might have not seen, that's The Social Dilemma. So wanted to ask you, if you have any thoughts about that, if you've seen it, and if you haven't seen it, or those who haven't seen it, I guess kind of the theme here, the question is around, where do we draw the line between us as consumers being valuable data, right? Whether it's Facebook, Twitter, and all the other technology platforms, and that kind of data being the breach of privacy. I know it's probably very sensitive topic, but if you have any kind of thoughts on the documentary or just on that topic in general, I think that would be really great to hear.
So I haven't seen the documentary, but my husband so I have like a relatively good view on, I think, what they were sharing. And I think it first and foremost is about privacy, and the way that a company approaches privacy and access to the identity of your data. And I can share from a Twitter perspective that we believe privacy is a right. It is not a privilege. We 2 years ago actually put our privacy settings and like the documentation around privacy out to our user base, and we said, does this make sense? Is it human language? Do you understand how to set your privacy settings? Do you understand how your data is being used? We got a ton of feedback from that, and then we used that to very quickly change our privacy settings. So if you go to the top left of the application, you'll see sort of like the hamburger, the 3 lines, and you can go very quickly into privacy. And our privacy settings are extremely easy to navigate so that you know what is being shared and how that data is being used. We also introduced a Twitter Privacy Center. We adhere to the regulations of GDPR, CCPA, so on and so forth. So I think that's the first thing. And we are not an identity-based platform, whereas other platforms are identity-based. So they're trying to get as much data on you in order to propel their business forward. That said, I think there is 2 other pieces to note. One is around regulation, and then the other one is around the value exchange, right? So there is a value exchange. If many of these services are free, and they are funded by advertising, and they're funded by advertising that is more contextually relevant to you based on what each of those platforms knows about you. And as all of this is an ecosystem, the brands and businesses and services that are advertising, they themselves are helping to fuel the economy. So as we come out of COVID, and it was interesting to hear Lizanne talk about, the services industry, like there are a lot of small businesses that are hurting. And one of the main aspects of our business and our strategy is to make sure that we can help small businesses find that next customer or that next consumer so they can continue to grow. And when they can continue to grow, they can invest again in their local economy. They can invest in the markets. They can invest in a college education for the future of their children. So these things are all collectively connected, but no matter what, there is never going to be a trade that we make on the privacy protection of our individuals. And when something does happen, which has happened before, if there is some sort of data breach, we immediately report that to the GDPR. We are above board on anything that possibly could happen. And that's in order to be able to, again, build that trust with our user base and also with people in the government that we work with. I think the last part of this is that there is very much a real a real element of this digital service tax that is on the rise. And, we've seen the DST implemented in France. So, and the concept of the digital service tax is that governments are, absolutely looking for new revenue streams, and they believe that, their population of people are an asset for them. And when a digital company, the likes of any digital company, not just social media, is utilizing the data of those individuals, that they should be taxed for that. In that current situation in France, Amazon actually passes that digital service tax on to an individual consumer, whereas we eat that cost. You just saw actually today, there was a lawsuit in Maryland. The governor there is trying to introduce a digital service tax for the state. And there was another lobbying, a lobbying group that actually has put forward a lawsuit related to that. And the reason for it is that when you start to tax any business that is potentially digitized, that starts to equate to almost every business, but also really those small local business owners, those small publishers, those local journalists who are just trying to get their story out, now are going to take on a financial burden that was first started to really probably target more so the sort of bigger companies like the Microsofts, the Amazons, the Facebooks, the Googles of the world. And so that's where we, being sort of in the middle of this from a size perspective, we very much believe in the open internet. We very much believe in the open flow of information and communication. But we also want to make sure that those smaller companies that could be put out of business with some of this regulation, that we're making sure that we're amplifying their voice so that the broader ecosystem remains healthy.
That's great. No, thank you so much for that. And that was a lot of great info. And I know we're kind of starting to reach on to the end of time. And I wanted just to take one question from the audience quickly. So one of our guests is asking, how is Twitter planning to overcome losing the trust of a big population of their users? You have any thoughts on that?
I would assume that was related to a political question around removing Trump from the platform. And
yes, yes, that was.
Yeah, and so I'll reiterate what I had shared. It wasn't a decision that we celebrate. It was a decision that was made based on a violation of our policies around harmful conduct. And there was very specific evidence that pointed to that there was the potential of inciting violence or glorification of violence that was coming through the language on the platform. And as I said before, the physical safety of people on our platform is always going to be the number one priority for us. So we will, we would stand by that in any country, and that would be related to any political party. It was not specific to the individual. It was specific to the violation of the policy overall. But related to, trust, I think one of the things that's most important for us is, again, we serve the public conversation, and the public conversation is best when it has multiple perspectives. And we have seen no impact to our user growth as a result of that particular ban, and we stated that in our earnings actually a couple of weeks ago as well. But that's I appreciate great. The question.
No, thank you. Thank you for addressing that. I know that's probably a little bit of a tricky question, but we really appreciate you kind of taking it on. And with that, we're going to wrap it up. And I just wanted to thank everybody for joining us today. Sarah, thank you for being here today.
Thank you.
Yeah, there will be a quick survey at the end of the webinar. And we are hoping, as Monica said earlier, on the behalf of our team, we are hoping this is just the first in a series of these great conversations that we can have with our friends and our clients around different topics of interest. So if you have any specific topics that you would like to learn more about, please let one of us know. And we hope to see all of you soon.
Thank you.
Thank you so much.